Today we'll talk about its Biden's plan on raising the capital gain tax proper. And our answer is that it's improper for the economics growth, but it's proper for the people's livelihood. Our paper talks about Joe Biden's new policy on tax. He proposed to raise the capital gain tax to 39.6%. First, we will clarify two questions: who will be taxed and who will be benefit. The tax is related to the capital gain. It's a kind of realized gain. It mainly affects 0.3% taxpayers who earn over $1 million. And as Biden said, the government revenue will be used into the American Families Plan. It will invest in education and child care to reduce the child poverty.
Based on Biden's new plan, we will begin our argument with more detailed introduction on capital gains tax, mainly focusing on the United States. A capital gain is realized when a capital asset is sold or exchanged at a price higher than its basis. Generally, they are included in taxable income, but in most cases are taxed at a lower rate. At the end of 2014, capital gain tax accounted for 5% of tax revenue in the United States. Although it contributes a small percentage, it is anticipated that the increased top rate from 20% to 39.6% will generate $40 billion more of the financial revenues in the US.
Next, we will use the self-control model to explain the investment decrease. And the tax on savings and investment is just like the tax on the long-term capital gains. It's a kind of the investment good. If someone has preference on deferred consumption, he will like to save and the investment. He will get less utility from the investment good now because maybe he will be taxed on the future gain. So this tax will cause decrease in the investment. And in our data shows that the 0.3% residents who will be affected by the tax policy will contribute more than 60% of long-term capital gains. So this tax is inefficient. And we can see that in the graph, the area of the rectangle is the revenue generated from the tax. Its area calculation determined by the tax rate and the investment volume change. Many researchers estimate the elasticity of revenue with respect to the tax rate. They used the state level panel data and then use elasticity to calculate the revenue maximizing tax rate. And in XNAP and the Zedar's research, they concluded that the elasticity is estimated to be minus 0.5 to minus 0.3, and the revenue maximizing capital gain tax rate is about 38% to 47%. So Biden's new tax rate can really improve the government's tax revenue. But we can also see that raising the tax rate can cause some increase in the daily loss in our investment activity.
As for its fairness, we compare it with taxing capital gains directly as it is part of the personal income. From the graph, it is obvious that maximum income tax is always greater than maximum capital gains tax rate. However, people who were paying capital gains taxes were not members of the income demographic who needs a massive tax break. Thus, it would be more equitable to tax it all according to the same progressive tax brackets.
Okay, next I'm going to talk about the short-term effect. First, it can trigger a sell-off of shares. The increase in capital gains tax could lead to a stock sell-off of about $200 billion, with an impact on US stocks about 5%, similar to that in late 1986 and 2012. The initial impact will be a person's decision to sell shares and gain profits now before tax increases. People may lock in earnings early on. Capital flows are likely to decline as people may be more reluctant to lock in profits or invest in other assets. If such a high tax has to be paid, earnings to trade will decline. Second is that the velocity of the stock market has obviously affected the bond market. The trend of US debt may keep pace with the stock market, and investors withdraw from the stock market. Because for high-income people, stock market investment will lose some tax advantages. At the same time, the overall situation of the bond market will also show a downtrend. The yield of 30-year US bonds is likely to fall for the fifth consecutive week, while the yield of 10-year Treasury bonds will fall for the third consecutive week. The rising trend of US bond yields during the year can be significantly curbed. The third one is that it can suppress market risk appetite. In the stock market, when the stock price rises and the capital gains tax rate is high, investors may temporarily fail to get the gain due to the high rate, which will keep the stock price high to a certain extent. When the price falls, investors will sell assets to enjoy the tax credit brought by the deduction of capital loss, which will make the stock price lower to a certain extent. Therefore, the price change in any direction in the market will be exaggerated, and the price fluctuation may reduce the relative attraction of the stock market. Next one, it can prepare funds for infrastructure projects and reduce the fiscal deficit. After the implementation of the U.S. economic stimulus bill, the total amount of U.S. government spending has reached $9.1 trillion. At the end of February 2021, the fiscal deficit of the United States has reached a staggering $474 billion, a year-on-year increase of 76.9%. If Biden's tax plans can be realized, the U.S. fiscal revenue is expected to increase about $3.35 to $3.67 trillion in the next decade, which will effectively elevate the pressure on the U.S. fiscal deficit. The tax increase will provide financial support for infrastructure projects. From the economic perspective, the infrastructure plan can bring a significant positive pulling effect on the GDP growth of the United States. On the other hand, investment in infrastructure construction will drive the development of relevant industrial chain companies and create a large number of jobs. The infrastructure plan will also greatly help to reduce the unemployment rate after the epidemic. The final one is it can narrow the gap between the rich and the poor and promote consumption. Under the influence of Biden's new tax reform plan, the increased tax burden will fall on high-income families. From the perspective of consumption, the tax increase on the rich is actually a redistribution of wealth. That is taking money from high-income people and then distributing it to low-income people. The year-on-year rise of individual disposable income of U.S. residents will significantly increase resident service consumption, and low-income families usually have a higher consumption propensity. Therefore, we can believe that the rising tax on the rich in the medium and the short term can drive the growth of U.S. GDP from the consumption level. And my partner will talk about the long-term effect.
Okay, in this aspect of long-term effect, the tax increase is also a disguise to reduce investors' enthusiasm for short-term financial investment, especially in the capital market, which is dominated by institutional investment, and the activity of the Singapore financial market will be relatively reduced. The volume of the financial market, such as Singapore stocks and bonds, will shrink relatively. After the adjustment, Singapore financial market is likely to induce capital outflow, and some funds must seek to invest in financial market of other countries. Next page. Investment decisions for industry, technology, business management, and environmental governance can create a better environment for high-quality asset financing than investment decisions for monetary policies or short-term change in the situation. After all, long-term value investment can help the economy grow steadily. Thank you. That's all for our presentation.